Exchange-traded funds, or ETFs, have revolutionized the investment landscape. They provide a flexible and accessible way for investors of all levels to participate in the financial markets. ETFs offer a unique blend of features from both individual stocks and mutual funds. You will learn their mechanics, benefits, drawbacks, and strategies for incorporating them into your investment portfolio. ETFs are investment funds that are traded on stock exchanges. They can be bought and sold throughout the trading day, with prices fluctuating based on supply and demand. Unlike individual stocks, which represent ownership in a single company, ETFs hold a basket of assets. These assets can include stocks, bonds, or commodities, making ETFs a powerful tool for diversification. Investors can gain exposure to a wide range of assets through a single investment. The rise of ETFs can be attributed to the increasing demand for low-cost investment options and the convenience of trading ETFs like stocks.
At their core, ETFs are investment funds that hold a collection of assets. These assets are selected based on a specific investment objective. For example, an ETF may aim to track the performance of the S&P 500 index, a basket of bonds, or a particular commodity like gold. When you invest in an ETF, you are buying shares of the fund, which represent a proportional ownership in the underlying assets. ETF shares are listed on major stock exchanges, just like individual stocks. This allows investors to buy and sell ETF shares throughout the trading day at prices determined by market forces. One of the key features of ETFs is their creation and redemption mechanism. Authorized participants, typically large financial institutions, can create or redeem ETF shares by exchanging the underlying assets for ETF shares or vice versa. This mechanism helps ensure that the price of an ETF stays aligned with the value of its underlying assets. Unlike traditional mutual funds, which are priced only once a day, ETFs offer the flexibility of intraday trading.
The ETF market has grown exponentially in recent years. It now offers a vast array of investment options to suit diverse goals and risk tolerances. ETFs are categorized by the assets they hold, providing targeted exposure to sectors, industries, or regions. Equity ETFs are the most common type. They track stock market indices like the S&P 500 or NASDAQ 100. Equity ETFs can focus on sectors like technology or healthcare. Bond ETFs offer exposure to diversified bond portfolios. Commodity ETFs track prices of commodities like gold and oil. Thematic ETFs focus on trends like renewable energy or AI. The variety of ETFs helps investors tailor their portfolios.
ETFs offer several compelling advantages that have contributed to their widespread popularity among investors. These advantages include diversification, liquidity, cost-effectiveness, transparency, and tax efficiency. Diversification. ETFs provide an efficient way to diversify portfolios. By holding a basket of assets, ETFs spread risk across multiple holdings. Liquidity. ETFs are highly liquid, easily bought or sold on stock exchanges. This provides flexibility and peace of mind. Cost-effectiveness. ETFs generally have lower expense ratios. Lower expense ratios enhance long-term performance. Transparency. ETFs disclose their holdings daily. Tax efficiency. ETFs are more tax efficient due to lower turnover rates. Fewer taxable events mean more investment gains. Section 5. Potential drawbacks of ETFs, risks and considerations. While ETFs offer numerous advantages, it's essential to be aware of their potential drawbacks and risks before investing. Understanding these drawbacks will help you make more informed investment decisions. ETFs are subject to market risk, which is the risk that the value of your investments will decline due to broader market movements. The value of ETFs can fluctuate, and you may experience losses, especially in the short term. Although ETFs generally have lower expense ratios than mutual funds, they do involve trading costs. These costs can include brokerage commissions and spreads, which are the differences between the bid and ask prices of ETFs. The performance of ETFs will depend on the underlying assets they hold. It's possible for ETFs to underperform the broader market or their benchmark indices. Some ETFs may experience tracking error, which is the difference between the ETF's performance and the performance of the index it tracks. When you invest in an ETF, you are essentially buying into a predetermined basket of assets, limiting your ability to customize your portfolio.
Section 6. ETFs versus mutual funds, a comparative analysis. ETFs and mutual funds are both popular investment vehicles that offer investors a way to diversify their portfolios. However, there are some key differences between the two that investors should be aware of. ETFs are traded on stock exchanges, just like individual stocks, while mutual funds are priced and bought or sold through mutual fund companies. ETFs are priced throughout the trading day, reflecting their real-time market value, while mutual funds are priced only once a day at the end of the trading session. ETFs offer intraday trading, meaning you can buy or sell them at any point during the trading day, while mutual funds can only be bought or sold at their end-of-day net asset value, or NAV. ETFs generally have lower expense ratios than actively managed mutual funds, making them a more cost-effective investment option. ETFs are typically more tax-efficient than actively managed mutual funds due to their lower turnover rates, resulting in fewer taxable events.
Section 7. Getting started with ETFs, choosing a brokerage and placing orders. Investing in ETFs is a straightforward process, similar to buying and selling individual stocks. Here's a step-by-step guide to get you started. To trade ETFs, you'll need to open a brokerage account with a reputable online broker. Consider factors such as trading fees, research tools, customer support, and the broker's trading platform when making your decision. Once you've opened your brokerage account, you'll need to fund it by transferring money from your bank account. Before investing in any ETF, it's crucial to conduct thorough research to determine which funds align with your investment goals, risk tolerance, and time horizon. Once you've selected the ETFs you want to invest in, you can place your order through your brokerage account's trading platform. After purchasing ETFs, it's important to monitor their performance regularly and make adjustments to your portfolio as needed.
Section 8. ETF Investing Strategies, Building a Diversified Portfolio. ETFs are versatile investment tools that can be used to implement various investment strategies. Here are some effective strategies for incorporating ETFs into your portfolio. ETFs make it easy to diversify your portfolio across different asset classes, sectors, geographic regions, and investment themes. The core satellite approach involves building a portfolio core with diversified ETFs, such as those tracking broad market indices, and then adding satellite holdings of more specialized or tactical ETFs to potentially boost returns. Dollar cost averaging is a strategy where you invest a fixed amount of money in an ETF at regular intervals, regardless of the market price. ETFs are well suited for long-term investors who are looking to build wealth gradually over time. Periodically rebalancing your portfolio by buying or selling ETFs can help you maintain your desired asset allocation and risk profile. Section 9. The role of ETFs in long-term financial planning. ETFs can play a crucial role in long-term financial planning, helping you achieve various financial goals, such as retirement planning, education savings, or purchasing a home. ETFs can be a cornerstone of your retirement portfolio. ETFs can be a tax-efficient way to save for your children's or grandchildren's education expenses. ETFs can be a valuable tool for saving for a down payment on a home. ETFs can be easily transferred to beneficiaries upon death, simplifying the estate planning process. By investing in a diversified mix of ETFs, you can potentially grow your savings over the long term and generate income during retirement. Section 10. Conclusion: ETFs as a valuable investment tool. Exchange-traded funds or ETFs have become an integral part of modern investing, offering investors a flexible, cost-effective, and transparent way to access a wide range of asset classes. By understanding the different types of ETFs, their benefits, drawbacks, and investment strategies, investors can make informed decisions and incorporate ETFs effectively into their portfolios. Whether you are a seasoned investor or just starting, ETFs offer a versatile tool to achieve your financial goals. Consider exploring the world of ETFs and discover how they can complement your investment strategy. Section 11. Glossary of ETF terms. A large financial institution that has the ability to create or redeem ETF shares. The difference between the bid price, the price at which buyers are willing to buy, and the ask price, the price at which sellers are willing to sell, of an ETF. The process by which authorized participants create or redeem ETF shares by exchanging them for the underlying assets or vice versa. The annual fee charged by an ETF to cover its management and operating expenses. The goal of an ETF to closely match the performance of a specific market index. The ability to buy or sell ETF shares throughout the trading day. The ease with which an ETF can be bought or sold on the open market.